So the highlights for steady facts in a spooky month. Government shutdowns, what do they mean for the market? I think people really seem to care about that. We're going to see if that's important or not. We're going to revisit the presidential cycle. So certainly the year one of the presidential cycle really was going according to plan, and in the last couple of months it hasn't. And we'll talk about that. We're going to look at the current money flow stats, which is always the most important thing to me. Is money coming in the market? That pushes it up. Money coming out, that's when we have a problem. And so we'll look at that. And then finally, we're going to wrap up with the Buffett Indicator and the Shiller P, which is definitely something spooky to consider given everything else. So here we go. Government shutdown, is that bad for the market? Well, typically it's actually not. These are all the times that the government shut down and what the stock market did. What really is evident from this is not much happens. If the trend was up, it stays up. If the trend was kind of choppy, it kind of stays choppy. Not really much is expected. The market doesn't really care. I think after the news, the market was down maybe 0.5% overnight, and it lasted maybe 4 hours of fear. I mean, we see this stuff happen in the futures market overnight rather than the daytime market these days. So it's just a fascinating dynamic shift. So I think it's interesting. I was certainly curious. Or should we expect something high volatility? Not really. It's just going to kind of keep grinding along wherever it's going. Whether you like it or not, it's just not going to make a difference. At least this metric will not. We're going to dive into others. The post-election year, we were expecting a really ugly time from August and September. We really didn't. What's interesting, and Chad actually found a stat on this, and I should have copied it here, but typically this year anyways, and more recently, the first half of the months are the strong part, and the second half are usually the weak part. And we did see that. Around the 16th, 17th, when the Fed cut rates, a lot of the bond indexes peaked. Some of the stock markets peaked right around then and just kind of drifted sideways and even down a little bit from there. So that's worth noting, but I would love to see, a good October like this suggests, but I'm also curious or maybe cautious because we didn't get the pullbacks that we needed earlier to really justify a really good run. So I don't know, are we out of gas here? We're going to see the pullback in October. October can be a scary month, and that's where we get some big surprises out of nowhere where the market can drop rather abruptly. I don't see much reason for it just yet, at least not in the short term. The trend is all there, the money flows there, and that's what we're going to hit next. This is the big advanced decline on the NYSE. This is money flow to me. It's money coming in, coming out. Really, since back in April after the tariff tantrum, resolved itself, it's just been steadily up. Money is generally coming to the market. There's really not a reason to be afraid or fearful. Because when money starts coming out, that's when you should be concerned. And we've had a couple little hints at it. It touched there mid-month here in September. It pulled out a little bit, but then it's back up. I believe today it is actually back negative below this red line, but that's like the early warning. That's like okay, we should be paying a little more closer attention. Above there, we just let things run, and that's fine. So there's really been no reason from a trend standpoint to be defensive, while the seasonality has said things could get really ugly here. What I look for is agreement between the two. I want to see trend agree that the seasonality is bad, and then we know the market's going to really sell off. We need to be very defensive and at the ready to protect capital, but we haven't had the reason to. So they're not in agreement, which is okay. It's just how it goes. Trend does come first, so I want to keep that in mind and at the forefront of what we're thinking about. Now, in the shorter term, this is, like I said, this is where the Fed cut rates right there on this red dot. It nailed it. It was crazy. And then money flow on the shorter term, and this is more of a micro trend compared to the previous. So this is a little more like looking for swings within context of the bigger picture. It is improving a little bit. I think this is still negative. I don't think we got a green dot today. It's not moving up that much. Most of the indexes are flat to down. I think NASDAQ is up, and that's it today. So far, we could actually get a push up here, and maybe we get a run to mid-month, and maybe that happens again. Maybe mid-month becomes the turning point again, and the second half is going to be ugly. That is a possibility that we're considering. One of the few exceptions is December, where the back half is actually a very strong part of the month to seasonality. But yeah, usually this part of the year that is very, very strong. So I'm curious to see if the money flow data backs that up for the future. Market indices, again, everybody's on the left side. Everybody's positive for their momentum, directional momentum. The strongest are, interestingly, emerging markets, China, and developed markets, lagging kind of in the mid or S&P, NASDAQ, and Dow. Small cap, mid cap are kind of not so impressive, but nothing on the red side, nothing on the right side. So nothing's really weak yet. But I'm always watching for a shift from left to right to the negative, and then you can see negative momentum build in the market. Right now, we just have Latin America and Japan are the only weak ones. So nothing else really looks too bad. We've got negative MACDs, but the market doesn't seem to care. So you just got to go with it. The trend is up and the market doesn't care. Good news, bad news, it doesn't matter. Back to the sectors. The sectors give a great understanding of the S&P. If the S&P is going up and these all are in agreement, it's a very strong trend. We're still in about a bit of a mixed bag here. We've got 9 positive sectors to 2, which is generally positive, but we've got several turning below. Energy, communications, and financials are turning below. That's not where you see strong moves or originate from. This is where you see the market getting tired. And we're seeing that. The market's not really running up that much. It's kind of grinding, it's meandering. It's not an impressive move by any means. So we're watching this. Again, money flow doesn't totally agree with what's going on here. So I'm looking for agreement. And then that I'm very interested in understanding that we need to get much more aggressive, or we need to start playing defense in a bigger way. And I think we'll get to that too. So again, in looking at the rotation, watching the ducks score on the pond, we like to see them move together in tandem. When they agree, big things happen. But we have, some going up, some going down, some really not sure where they're going, like industrials and consumer staples. Healthcare shot up. I think some interesting reasons for that are really outside of reason or fundamentals, but it's just interesting. Healthcare had a bit of a jump, and I realize that's probably more political, and I don't know how long that's going to last. Tech is kind of getting tired. Utilities, this is just not pretty. I want to see everybody group up here and then start to fall. And we know we're here near a top, or everybody down here like they did in April. We had a beautiful run up out from that point. So I want to see agreement, and this is just a mess. So not much to understand from this point. Also looking at the new highs, new lows. Just the new lows on the NYSE. There's really been no reason. We kind of look for spikes below the 100 when we start seeing 100 stocks or issues more turning negative below their just hitting new lows. Then something might be out wrong in the market, but there's just been no reason. Again, the taper tantrum, huge numbers of markets or issues hitting new lows. And that made sense because if the fear was there. We just haven't had fear in the market. There's really not much to be concerned about. So this is something else we're watching as a factor. I'm finding it very useful to keep an eye on for giving context of how bad something may be. At the moment, there's nothing. And it'll be fun to show this in the future as things may get more interesting. Thanks to Chad for this part. We grabbed this from, I think you grabbed this from Twitter. This is the Buffett Indicator. Now, this is the spooky part. I think there are some valuation problems. I'm not typically a fundamental first thinking person, but I like to note it when the big picture is maybe a little bit out of whack. And guess what? I think we are. Buffett Indicator, when the stock market value to GDP gets overvalued by about 2 standard deviations. It did that in 2000. Remember the tech boom and then bust for like 3 years. It came down. That was really ugly time. This actually was the peak in 08. And then it crashed. Now that wasn't as much of a spike, but here, remember 2022, which was actually the second year of the presidential cycle last time, was the peak. And then, that got ugly for a bit. We had the market falling 20 to 30%, depending on the market, for the entire year. And that was pretty ugly. So we are back up in that area. I don't love that. Doesn't mean it has to stop now. Music's still playing. There's no reason to find the exit yet, but keep that in mind. I mean, that's not a great place to be buying and getting aggressive, which I think interestingly, we're seeing some of the more scaredy cat investors going, hey, I need to be part of this. And it's like, that's when these runs end, is when you see that happening. So that's something we're keeping in mind as well. And then finally, the Shiller PE ratio is at the second highest number it has ever had. The previous huge peak was the tech bubble. So theoretically, this could actually run a little bit higher. I don't know how much longer it's going to run, but my concern is how bad does it get when this is done running? And I think we're going to have to be very defensive. But, we have a plan for that. I'm actually excited. We're leaning more and more into market neutral thinking, where you don't really rely on the market's direction. It can go up, down. It doesn't matter. You're buying weakness, selling strength, or buying strength, selling weakness as a pair, and it just kind of it helps you make it through these situations. So more and more of that thinking. I'm excited for these next bad times. For our investors, I think we're going to manage it very, very well. That is my hope in the future. So.